In Brussels, the European Union's unprecedented move to seize profits generated from Russia's frozen central bank assets was celebrated as a bold and moral victory by many Western leaders. The decision was framed as a necessary step to hold Russia accountable for its actions in Ukraine, and to demonstrate the EU's resolve in defending international law and order. Redirecting a staggering $105 billion to Ukraine, the EU aimed to provide not just financial support, but also a powerful symbol of solidarity with a nation under siege. The world watched as aid supplies were loaded, and the figure flashed across news screens, signaling a new era in economic warfare. But on December 18, 2025, the world was left reeling from the aftershocks of this seismic decision. Headlines blared warnings of a global finance crisis, and traders on stock market floors scrambled to make sense of the rapidly changing landscape. The message sent to every nation was chillingly clear. Your reserves in Western banks are only truly safe if your politics align with those of the West. For countries with differing views or strategic interests, the security of their assets was suddenly in question. Moscow's response was swift and severe. Russian officials branded the act as outright theft, denouncing the West's actions as a violation of international norms, and retaliated in kind with measures that shocked global markets. European corporations, some with decades of investment and presence in Russia, saw their assets nationalized overnight. Employees were forced to leave, and headlines declared the end of an era for Western business in Russia. The global economic order, long built on trust in Western institutions and the rule of law, suddenly looked fragile. Investors and governments alike began to question the very foundations of the system. Finance ministries from Riyadh to Beijing convened emergency meetings, openly questioning the safety of holding reserves in dollars and euros. The reliability of Western currencies, once considered unassailable, was now up for debate. A quiet, but unmistakable exodus from Western financial instruments began. Central banks and sovereign funds started to diversify, moving assets into alternative currencies and markets, threatening to shift the balance of economic power away from the West. This story explores the far-reaching consequences of the EU's asset seizure, Russia's forceful retaliation, and the resulting erosion of trust in Western finance, a trust that took generations to build, but only days to fracture. We'll examine how a single, controversial act triggered a global shift away from the dollar and euro, and what this means for financial hubs like London and New York, whose influence now faces unprecedented challenges. Ultimately, we must ask, by punishing an enemy, did the West inadvertently undermine its own greatest strength, the world's trust in its financial system? The answer may have consequences that reach far beyond the current crisis. As policymakers grapple with the fallout, the reality is more troubling than anyone in power ever imagined. The world's financial landscape has been irreversibly altered, and the true cost of this decision is only beginning to emerge. The saga began in early 2022, when the world was shaken by Russia's invasion of Ukraine. In a move that stunned global markets, Western nations responded by freezing a staggering $300 billion of Russia's central bank reserves, an amount almost unimaginable in scale. This was not just a financial maneuver, but a signal to Moscow and the world that the rules of international finance were being rewritten in real time. At first, these frozen assets were seen as powerful bargaining chips, leverage to bring Russia to the negotiating table and encourage a peaceful resolution, not as permanent spoils of war. Diplomats on both sides engaged in tense, high-stakes talks, hoping that the mere threat of losing access to these funds would be enough to force a compromise. But as the conflict dragged on, with no end in sight and the costs of war mounting for all involved, the European Union began to debate a far more radical step. The idea emerged: what if they didn't just freeze the assets, but actually seize the profits generated by these frozen funds? The debate was fierce, with some seeing it as a necessary escalation, while others warned of dangerous precedents. Legal and financial risks loomed large. The principle of sovereign immunity, long considered sacrosanct in international law, was now at stake. Financial advisors and legal experts warned of unpredictable consequences, not just for Russia, but for the entire global financial system. Yet, by late 2024, after months of heated debate and behind-the-scenes negotiations, the EU found a creative workaround. Instead of seizing the principal, they decided to redirect only the interest and profits generated by the frozen assets to Ukraine, providing much-needed support without technically crossing the line into outright confiscation. The United States quickly backed the move, hailing it as a clever and pragmatic way to fund Kiev's defense without triggering a full-scale financial war. American and European officials presented a united front, emphasizing the legality and necessity of the decision. The decision was celebrated across Western capitals as a victory for justice and a bold stand against aggression. Headlines declared a triumph for international law and solidarity. But beneath the surface, many underestimated Russia's willingness to escalate in response. The calculation in Western capitals was that Russia had little recourse, but the reality soon proved to be a monumental misjudgment. In Moscow, officials weighed their options and the world braced for unpredictable consequences. The move shattered long-held assumptions about Western dominance in global finance. It opened a Pandora's box of uncertainty, sending shockwaves through financial markets and prompting countries worldwide to reconsider their own vulnerabilities. The world watched in real time as the EU crossed a line that many thought was unthinkable, setting a precedent that would shake the very foundations of international finance and trust between nations. What began as a targeted sanction against one country quickly became a catalyst for global realignment. Leaders from every continent scrambled to assess the new risks and opportunities in a rapidly changing world order. The West believed it held all the cards, confident in its power and unity, until the cards began to fall, one by one, revealing just how fragile the system truly was. The consequences of this unprecedented action would soon be felt far beyond Europe's borders, rippling through economies, alliances, and societies across the globe, changing the world in ways no one could have fully predicted. Moscow's response was immediate, leaving little room for doubt about its intentions. The Kremlin acted with ruthless efficiency, determined to send a clear message to the world. Within days, new laws were rushed through parliament, empowering Russian authorities to seize assets from so-called unfriendly countries, essentially every EU and G7 member state. Major European corporations operating in Russia were the first to feel the impact. Factories were shuttered, bank accounts frozen, and valuable intellectual property was confiscated without warning. German, French, and Italian firms, some with decades of investment and deep roots in Russia, saw their assets vanish overnight, leaving executives stunned and scrambling for answers. Russian courts, acting swiftly, rubber-stamped the government's seizures, offering European companies no legal recourse or hope of appeal. The value of the assets seized was carefully calculated to match the funds that Western nations had redirected to Ukraine, a cold, calculated message of symmetry and retribution. The retaliation was not random, it was strategic, targeting those countries most vocal and active in supporting the EU's plan against Russia. The era of predictable, rules-based business in Russia ended abruptly, replaced by an atmosphere of uncertainty and fear for foreign investors. Western firms, once confident in their foothold, suddenly found themselves pawns in a new and unpredictable economic war, their futures hanging in the balance. The Kremlin had weaponized foreign investment, making it clear that it was willing to absorb economic pain if it meant inflicting even greater costs on its adversaries. The shockwaves from Moscow's actions reverberated through boardrooms across Europe, forcing companies and governments alike to reconsider their strategies and brace for a new era of confrontation. European corporations faced catastrophic losses as Moscow retaliated. Blue-chip firms wrote down billions, erasing years of investment in Russia. German manufacturers lost factories and patents. Austrian banks lost entire subsidiaries. The fallout triggered job cuts, political backlash, and a rift between business leaders and EU policymakers. The dream of integrating Russia into the global economy collapsed, replaced by a fire sale of European assets. The cost of a political decision in Brussels was paid by Europe's industrial backbone. The most profound impact wasn't financial, it was psychological. For decades, sovereign assets in Western banks were considered untouchable. The EU's seizure of Russian profits shattered that trust. Suddenly, central banks worldwide questioned whether their reserves were truly safe. Political risk now applied to New York, London, and Brussels, not just unstable regimes. The safety of the dollar and euro became conditional, dependent on political alignment. Emerging economies saw the West's move as a warning. Rules could change overnight. The precedent justified calls for de-dollarization, especially from China and others. The West's short-term gain came at the cost of its long-term financial credibility. The world's faith in Western finance was no longer absolute. The rules had changed, and so had the global calculus. The era of unquestioned trust was over. The risk was no longer theoretical. Nations acted quickly, Central banks ramped up gold purchases, storing bullion at home, immune to sanctions. Bilateral trade in local currencies surged, with China leading the push for yuan-based deals. Alternative payment systems like China's CIPS and Russia's SPFS gained traction. Even Western-aligned countries diversified, seeking havens in neutral states like Switzerland. The world's wealth began to flow along new, less politically exposed pathways. The Great Diversification was underway, not as a panic, but as 1,000 quiet decisions. The unipolar financial order was fracturing. Commodity markets became the next battleground. Russia demanded payment in rubles, yuan, or friendly currencies, bypassing Western systems. New trading hubs in Dubai, Hong Kong, and Singapore rose as Western firms were sidelined. Yuan-denominated oil contracts gained relevance, challenging the dollar's dominance. The petrodollar system began to erode as oil producers accepted alternative currencies. Each non-dollar transaction weakened the old order. The asset seizure accelerated a shift that had been brewing for years. The global map of trade and finance was being redrawn. The EU's decision was driven by moral urgency, to make Russia pay for its aggression, but enforcing justice risked undermining the very system that empowered the West. Trust in Western finance is a strategic asset, not just an economic one. The move divided allies. Some pushed for aggressive action, others warned of long-term costs. The dilemma: uphold moral principles or protect strategic interests. The unintended consequences were profound, rippling far beyond Russia. Western leaders now face a world where their financial tools are viewed with suspicion. The balancing act between values and interests has never been more precarious. As trust in Western finance waned, new financial centers emerged. Dubai, Singapore, and Swiss cities marketed themselves as neutral havens for global capital. These hubs offered stability and non-alignment, attracting wealth from Asia, the Middle East, and beyond. The dominance of London and New York was no longer assured. Liquidity and influence began to shift, threatening the old financial order. The asset seizure controversy fueled this trend, accelerating the rise of a multipolar system. The world is moving toward multiple reserve currencies and competing financial centers. Trust, once broken, is hard to restore, and the long-term cost may be the West's own financial supremacy.